Great, thanks so much, Omri and Pallavi. As a multi-manager, as a fund manager, I always enjoy listening to the different views and picking up on the differences. The one difference I think that's quite stark between your two funds is certainly the amount of equity you're holding. Coronation seems to be quite high on the equity exposure at the moment, where Omri, like you've showed, you've increased your global equity, decreased your SA equity, and at a net level, definitely much lower positioned. Pallavi, I want to start with you. Looking at your total equity exposure, as an N investor, it might seem aggressive and risky and scary. Maybe you can talk us through, within that high equity allocation or above long-term average equity allocation, how do you think about the different risks within that? How do you diversify the stock selection, think about SA Global, just to maybe make it less scary for the end investor?
Yeah, thanks, Sune. I think there is a perception out there that having such a high equity allocation comes with more risk. But I think once again, you marry that with starting valuation levels and starting multiple levels. There is less risk by increasing equity when markets are more attractively valued than when, of course, markets are more expensive. And one of the things that we think, as I mentioned in my presentation, is the SA market overall is actually looking very cheap at the moment. And I think we're pretty similar, Omri and ourselves, on the SA equity side. I don't think you'd find much disagreement there. I think on the global equity side, two things to bear in mind. Firstly, just from an overall exposure point of view, although we've picked up global equity exposure from 20% at the beginning of the year to 25%, we've kept in place quite significant levels of put protection. So we came into the first quarter and we actually saw risks escalating with the Russia-Ukraine war. We actually stepped up put protection from 20% of global equity to 30% of global equity under put protection. It's a pretty simple instrument. You pay away the premium. It's like paying away an insurance premium. And in the event that things go south, it works for you. Otherwise, it's a net cost. But we thought going up to 30% of put protection was appropriate. And that really worked out for us in the last 6 months in terms of at least mitigating some of the downside on global equity. And then within the different baskets, once again, as you mentioned, our instrument selection in the absolute return space will be far more defensive than, for example, higher risk funds at Coronation. We have a large position in British American tobacco. Omri mentioned that had actually done very well in the SA equity context. It was one of the biggest contributors to our alpha in our SA equity bucket this year. And within the resources sector, once again, a couple of shares for us that have come through quite nicely have been Glencore and Exxaro. But once again, although we found those opportunities very attractive, we could have had much larger positions. We've once again mitigated our exposure to overall commodities because we recognize it's a cyclical sector. It has generally been a poor returning sector over time. But we still thought they were attractive enough to have a position. They've worked out, and when they rallied, we trimmed our position sizes again.
So, I mean, to summarize that, various events and various catalysts would work for different pockets of your equity. It's not like equity seen as one big block.
No.
And
I mean, the other point to make would be on China tech overall. Naspers Prosus had a big derating this year. And that was a big headwind for the SA equity performance, but we balanced that with our look-through exposure in the portfolio, containing our emerging market exposure, overall in thinking about broader China exposure, not just Naspers Prosus, thinking about our exposure to Richemont, buying some Prosus bonds in the sell-off this year, which were giving you very attractive real rand returns. So we broaden our exposure across buckets. We think about the overall portfolio exposures to select instruments, and we try and manage risk from an overall portfolio level.
And Omri, in your global equity allocation, I mean, US equity seems expensive, developed markets fair. Are there certain sectors that you're keeping an eye on that you expect to maybe under certain conditions or specific catalyst that you could be start to buying in or increasing your risk?
No, absolutely. So, I mean, what's happened because of this sell-off, it's actually been indiscriminate. And you found sort of global cash flush quality franchises that are down 60-70%. Examples would be, we've always liked the likes of a Google and an Amazon. It's always just been too expensive to buy. I mean, now you can buy sort of a Facebook at a single-digit PE. So we've never owned it, but more recently, US tech has actually been a sector where we've increased. And similar to what Pallavi has said, the sell-off in Chinese tech, it was indiscriminate. And there are companies that have got cash on the balance sheet that's trading at or below cash levels. So yes, there's a lot of regulatory risk and industry risk, but you have to look at what is the valuation and how much of that risk is already discounted in the share price. So those were two of the big moves in global equity, US tech and actually Chinese tech. And we've balanced that by reducing our Naspers position. Before a big part before the large sell-off that we saw, both through hedges that we had in place, like what Pallavi said, we use similar instruments, and also actual selling at high levels. And then more recently, we've actually bought back a few because the discount was again a very attractive. But it is balanced with having a capital protected instruments also within the fund to withstand a further potential sell-off in the market. We haven't seen this kind of volatility in a long time, and I don't think it's over. It's not. So one has to be quite nimble in terms of your asset allocation and having those protection levels in place.
Yeah. And speaking of global equity, managing funds for South Africans, you can't ignore what the currency is doing, what the rand is doing. Omri, I know ABAX is very actively looks at it and tries to understand. It's impossible to forecast, but trying to understand the current valuations. So maybe just talk us through, while global equities are looking attractive, there are pockets of value. Managing money for South African investor, how do you think about the currency, and how do you marry the current situation where we've had a few days where the rand's weakened, global equities are falling, and it's actually turned again. Now the rand's stronger. Just how do you marry those two valuations? Because both need to make sense at the same time, right?
Yeah, it's interesting. I think the way that one manages global assets from a South African context has changed. With the old Reg 28 limits of 25%, that wasn't really a limit, it was a target. You just went straight to 25% and sat there. Now with it at 45%, that's an active asset allocation decision that you have to take. So the way we manage it at ABAX is almost taken a decision independently. You decide what securities you want and where you want it, and then you say, okay, what do you want your currency exposure to be separate to that? Because we've seen in the last 5-6 years, there have been 2 periods of significant rand strength. And that can hurt your portfolio. If you've now got 45% of your portfolio in global assets and the rand suddenly strengthens 15-20%, that's a big hit to your portfolio. So not only do we look at hedging at the sort of equity level, we also look at hedging from a currency perspective to ensure that significant rand strength also don't hurt your performance too much.
Yeah, it's such an important point to pick up on because, our view on what the currency will do. I mean, one of the common client questions we get asked is, what do you think about the rand in the next 6 to 12 months? And the only thing we can guarantee you 100% is we'll be 100% wrong. But we do try and attempt to a fair value for the rand. And what we see is there are times when there are significant dislocations to at least our estimate of fair value. And we know that within that estimate of fair value, you might be wrong by 10% here or there. But when there are significant dislocations, over and apart from strategically thinking about your currency exposure in the portfolio, you can take some tactical hedging into place. And we have done so in the portfolio. We saw the rand being abnormally strong the first half of the year. And we thought that it looked quite strong relative to other currencies. Then we saw it blow out to 18 Rand 50. We actually hedged some of the currency back into rands at that point in time, and now we've seen that subsequent unwind. We're not yet ready to take those hedges off, but it does provide some tactical opportunities on the currency side to protect the portfolio. But I do agree with Omri, once you decide to take a significant part of your assets offshore, and we would guess that would be anything from 30% plus, you need to start actively thinking about how you're going to manage that currency exposure, because it can have a significant impact on rand returns.
Yeah.
But just another point, Sunay, and I think Pallavi also referred to it. In the past, you'll use a global equity fund as a building block. But given how it's changed, one has to look at it from an integrated approach. And that's the benefit of being in a multi-asset fund is that you can look at what does my local equity exposure look like, what sectors do I have exposure to, what's my sort of valuation level, is it cyclical, or is it defensive shares, and then you can diversify into the right shares that make sense from a portfolio context. Yeah. Whereas if you use building blocks, those are two totally independent, and you can actually have quite a lot of correlation risk that you're actually not even aware of.
Yeah, I mean, because now with the increased offshore location, it's no longer, you're not forced to buy British American Tobacco. You can buy a Philip Morris and all those other global companies. How big a role does the currency then play? Like, how do you distinguish between the BAT listed on the SA Stock Exchange versus some of its global counterparts? And do you then have to factor the currency in, or is it a pure which company offers better value?
I mean, from our perspective, it would be which company offers better value. I mean, I think, especially when they're in the same sector, right? Yeah. The only differences on a currency point of view would be the markets that British American Tobacco are exposed to versus the markets that Philip Morris are exposed to. So British American Tobacco, we know, for example, has a large US business. It has less emerging market exposure than Philip Morris. So it's just cognizant of the underlying operational currency exposures in those two, and the rand doesn't really play an impact there. So we look at fundamental valuations when we're comparing like for like. But as you said, I think now, and Omri has also brought up the point, you now have the opportunity and the flexibility to invest in all these other shares. I mean, we have already started making some of those changes, as I'm sure Omri has done as well. You look at your SA listed exposures, and you can now look globally and say, are there better exposures to have? So say, for example, we're very constructive on oil. We're constructive generally on energy in the medium term, given what's happened in Russia, Ukraine. Previously, you were pretty much constrained in South Africa to holding a high Sasol position. And we know that Sasol, yes, it looks cheap. It looks like it's coming out of its whole big investment phase. There's potential to generate a lot of cash. However, we also know that it has long-term transition risks, long-term environmental risks that it needs to deal with. If you are constructive on energy in the medium term, are there better plays offshore? We certainly think so, that are as cheap, that are returning cash to you as shareholders. And so we've switched some of our Sasol into direct oil plays in the US space. So we are already making those side-by-side comparisons and choosing better alternatives for clients.
And while we're on the resources, Omri, I'm sure you get asked this a lot. I mean, Thungela's been a massive winner for the fund.
Yeah.
Is it still attractive? Do you still like the stock, or is it starting to reach a point where the downside risk is coming into play?
That's an important point. I mean, it's been one of the top contributors to performance. I think since listing, the shares up over 1,000%. It's been phenomenal. I mean, it started off as a small position in the fund, and because of its performance, it actually grew, and you keep on taking profits. But even at current levels, we still see quite a bit of value. It's got 7 of the highest quality coal mines in South Africa. It's a company that's been going for 80 years. The coal they produce has got quite high calorific content. They sit with cash on the balance sheet of over 10 billion rand. They're probably going to earn close to 100 rand in the next year. The share's trading at 240. So it's almost half your share price is being earned, and they're going to pay out most of those are dividends. So you're probably going to get close to half your share price back in dividends over the next year. Sure, it is very dependent on the rand coal price, but as like Pallavi, we are quite constructive on energy, and coal price is a derivative of energy. So we're still positive on it. I mean, their preference is Glencore, which is also a sort of a good proxy for that. Our play is through Thungela.
Was there anything specific, Pallavi, about Thungela that made Coronation choose Glencore over Thungela?
Yeah, I mean, well done to Omri for holding on to his Thungela. He's certainly done very well out of it. I think for us, the concerns around Thungela would be, when we think about coal prices, obviously not just where coal is sitting at now, we think coal will normalize much lower. Our fair value for coal would be around the $90 versus 170 where it's trading at in Europe versus 300 where it's trading at in Australia. So our assessment of normal coal prices will inform the values that we put on companies. And at a $90 coal price, we don't see much value in Thungela. We do think that both Glencore and Exxaro can make a lot of money at $90 coal price. And then in addition, once again, thinking about the geographical spread of assets for Glencore, a little bit broader than just South African coal, and Exxaro as well, selling not just coal for export markets, but selling to Eskom and getting an annuity stream on their coal sales, which Thungela does do for a little bit, but it operates more largely in Exxaro. Thank you.
And while we're on that positive note of a top-performing stock, I'm going to leave you guys with the same question to end off the session. Omri, you can go first. When you think 2023, what's the one expectation or outlook or catalyst or dream, let's call it, in terms of a market event that makes you most excited in terms of the current positioning? Looking forward.
I'm very excited about the real yields on offer in the bonds. It's not often that you get a free lunch. And when you get offered 11.5% nominal returns and inflation look to normalize at sort of 5%, you can lock in a 15-year bond. You can lock in a real return of 6.5% for 15 years. So what I should be doing is put everything in bonds and go on holiday for 15 years and then come back, and the fund would have done very well for clients. But we have to try and earn our salaries, so we'll try and do a bit of tactical trading around it.
Yeah, good question. I think, first and foremost, I'll just frame it. We're not allowed to use the word catalyst at Coronation. It's actually a swear word. But if I had to have a positive catalyst, if we could solve Eskom's problems, I would take it.
Okay.
And I think we would do very well in the funds if you managed to solve Eskom. It would be a really positive outlook for South African fixed income. Taking away the load shedding constraints would mean a lot of SA companies would do much better. I think the whole SA equity market would re-rate because we would start attracting foreign flows. So yes, if I could wave a magic wand, I'd solve Eskom's load shedding problems.
I think everyone would be very happy if you can achieve that. Great, thanks so much, Omri and Pallavi. I really appreciate your time, and I'm sure the listeners really enjoyed listening to your insights. I'm going to steal one more minute before I let you go. I just want to quickly position a few documents that we'll be sending out in the next day or two. We've redesigned some of our select collateral, and just quickly on the screen, you can expect from myself in your inbox a brochure that captures the select fund of fund range, what the funds are, what the benefits are. It also covers within each fund of fund who we are invested in, how the funds are structured, and we've also put together a really nice characteristics document which shows you for each fund of fund and each of the underlying funds within that what the important things are. How much offshore, how much equity, which is CISA category, the benchmark, and the time frame. And then we've also made or revamped the fund selection aid, which helps you have that conversation with the client to show if you're trying to achieve this much growth, which fund is suitable, what time frame is suitable, or from the other perspective, if a client has this much time, which select fund of fund will be suitable for them. I'll be sharing these with you shortly, so you can expect them from myself in your inbox. And with that, we'll end off the day, and thank you very much for dialing in and taking part in our final Select Insights for the year.